Everyone wonders, what would have happened if you bought Bitcoin back in 2010 or Tesla stocks when they were first publicly traded? In this video, I will share with you how to find the investment opportunities before they blow up. Identifying the right investment opportunities at the right time is a challenge for all of us. If you look at the Bitcoin chart from the past 5 years, you will ask yourself, why didn't I buy Bitcoin at its lowest points? But let's be honest, how many times did you ever manage to buy something at its lowest point? Or are you like the younger self of me, buying always at the highest point and then losing some money down the line? Let me share with you the most common reasons why people fail in investing. Number 1. People are not patient. Most of us look for a quick fix, fast money, to buy a product or service that we have in mind, or to pay for the next holiday. This pressurizes us, and with that we cannot think rationally. So if then things go worse, we panic and sell our stocks. This is one common mistake, as investments are long-term and markets might recover eventually. Second reason, people are emotional and follow the crowd. Emotions can run high, especially when the market is up. People get excited and start buying stocks. When the market goes down, people get scared and they sell. Oftentimes, emotional decisions are wrong decisions. Those decisions are also driven by the crowd and intensified by them. Warren Buffett once said, "If I'm invested in a company and the price goes down, I'm more excited because now I can buy more stocks of it." And Warren Buffett can say this because he has educated himself on the value proposition of that company and he knows what that company delivers as a service. And with that, we come to reason number 3. Most people do not even understand how markets are working, so they are not diversifying their portfolio. One key problem is that people do not spend the time to educate themselves on a specific topic. And unfortunately, most of the times we have the wrong attitude towards money. Because we work very hard to get a few dollars, but are very careless when it comes to spending. If you would just compare the time, how long it takes to spend that money on an investment and how long it took you how to get that money in the very first place, then maybe you would think more rationally. Just know that the path to make money is actually much harder than to spend it. And after we discussed these 3 reasons, let's come to the question how to pick investment opportunities before they actually blow up. Well, that's the $1 trillion question. If I would have the answer to this question, I would not make any YouTube videos. But I can share with you some tips and tricks I use how I minimize my investment risks. Tip number 1. Look for companies with a competitive advantage. So, example given, which companies have patents and technologies? Which companies have a strong brand recognition? A good example for early brand recognition would be Devin AI, developed by Cognition Lab. As some of you may know, Devin was promoted as the first AI software engineer who can solve tasks on itself and read as well as through the newest documentation. Although they are not publicly traded yet, it gives you a good indicator about the market interest and the market trends. And with that, we come to the tip number 2. Watch for the newest market trends. With that, I mean just keep an eye on the market and watch for niches that may experience some growth down the line. I want to use that AI example and apply this to a very specific niche, AI healthcare. For example, it is stated that AI can help analyzing X-ray images with the best knowledge of all the doctors worldwide. Furthermore, the healthcare industry is experiencing massive growth with the development of the 5G technology. Nowadays, for example, doctors can do remote surgeries. So a tip from my side, look for companies that are working on 5G technologies, especially in the healthcare sector, and as well as the application of AI and the integration of those technologies. These were some qualitative factors. Let us now look on quantitative ones. So the third tip, monitor the volume and the price. If the trading volume rises, it stands for growing investor interest. 4. Look for companies with strong cash flow, increasing revenue and profit. This information you can read up easily on every financing platform. Now we looked at quantitative factors and qualitative ones, but now let's look on 2 tips I have for you which are based on your character. Exit at your target price. Do not be greedy. And with that, we surely mean fight your ego. And the sixth tip, and for me the most important one, is be honest to yourself. If you do not understand anything, do not invest in that. The following sources I personally use to stay updated. For general finance news, I use Yahoo Finance. For general news, I use the CNBC. As an alternative for that, you can also look up on Wallmine, and for the newest tech information and tech startups, I use TechCrunch. So to conclude, there is no gold standard in investing. Just ensure to discipline yourself and do not get caught up by emotions, as those can be your downfall. I would say trust your gut. Mine is very bad, so therefore I cannot say that. And that's why I try to rationalize everything and quantify where possible. If you enjoyed our content, make sure to like and subscribe. Also follow us on every social media channel. You will find linked in the description box down below. See you in the next one.